Hi guys, it's me again, Tony Lim, and today actually I want to take this short video to share a little bit about the habit of most of the successful stock investor, or we call it value investor, that they practice in their stock investing, and to make them to be a very successful and enormous results. Then there's huge of profit that they have made in their stock investing. Well, before getting started, then we have to understand a little bit of history about value investing and how those people they can actually to use the value investing methodology and to make them to be so successful. So if we talk about value investing, we cannot actually avoid to talk about number one, that is the fathers of value investor, which is Benjamin Graham. So when we talk about Benjamin Graham himself, then we do need to actually understand that one of the students, the most successful students from Benjamin Graham, which is Warren Buffett, right? And when we talk about Warren Buffett, we cannot actually forget that is another very famous, which is growth stock investment methodology we have used by this we call the Peel of the Fishes, that he uses the controlling investing methodology and make them so successful in his fund that under his management. And in today's world, then we can see that one of these very successful investor that using this value investment and manage a fund and really make huge and enormous of return, that is Bill Mills. That for information, the history of past 16 years, that if you actually total up that the average for what is returned, we can find that it's most probably it will be around nearly, which is no joke, is about 100% or more. So how this guy actually can be so successful, and if we actually go to understand all those value investors, they have one very common habits, and not only one, that is actually a few. Then today I will actually pick a few of these habits that is under all those value investors and to share with all of us, and hope that this actually will give you some value and benefit that you can bring back and help you into your investment and in your stock investing. So today I will actually take this opportunity to discuss a certain point which is I have wrote in my book. And my first book actually is this one, which is called The Powerful Value Investing Formula, that you can see. And this book actually you can get it from MPH right now in Malaysia. So if you want to get it from overseas, that you actually want to buy from overseas, you can go to online and order. So another one which is I would like to share a little bit of the points from my second book, which is just probably to introduce to you, which is this one, which is How to Build My Own Cash Machine to Stock Investment. And this book actually is currently is only available to online purchase, which is you have to go to my website, which is TonyLimST.com, then you can find this book. Alright, so what I'm going to share is in these two books that I have actually written, there's three very important points, which is all those value investors, they are very successful investors that they practice, which is number one, we could talk about what is the main habit that most of the value investors they will actually practice one. Number one, we can say all those successful value investors, they always purchase the stock in the market prices far below the real value. Or for Benjamin Graham, or we call it Warren Buffett, they call it is margin of safety. Okay, what does it mean? Margin of safety is actually you actually get a stock. Let's take an example that we calculated that the share is worth $15, and then it actually have a discount right now in the market price that's selling $7.50. So it's total for $7.50 in discount. So it's 50%, right? So it's called margin of safety. What is number one? They will actually practice. And number two, which is to gain at the right time. So do I mean for getting at the right time? Because if today we are choose the right stock, which is a good fundamental stock, and we understand that stock, but the problem is after we calculated the real value and we get it at the wrong time. Perhaps if we get it at 2007, the Lehman Brothers crisis, or we get it at 1997, the financial crisis, then we will get hurt. Okay, so we will get burned, right? Get burned out. So the most important thing is, second point is to choose the right time to enter. So we talk about this, we talk about Bill Miller. So the Bill Miller actually is a very successful fund manager. So how we do it is very simple. He just actually practice what is Warren Buffett has taught and Benjamin Graham had taught. So he actually go and calculate the intrinsic value, or call it the real value of the company. And after that, he actually will look for those industry or those stock which is undervalued, and he get in and he always actually trade along the way in this so-called the range of the real value and also the market price, which is I call it the value box trading system, which is I'm using it for around 11 years, which in my first book, The Powerful Value Investing Formula that I've mentioned just now, which is this one that you can find in the MPH. So this way actually is not difficult. Is number one, we need to know about the real value of company. This is number one. And after we get to know already, then we have to go to a technical site and just evaluate that when is the right time to get in and out, and just do the so-called the short-term trading along the way. But bear in mind, we do need to actually segregate 60 to 40% the ratios, which is 60% we have to go for long-term investment and 40% only we can use this methodology. Why? Because most of the very successful hedge fund manager, they understand that value investing is the ultimate way. That because we absolutely cannot, trust me, be you are the best analyst in the world, we will not be able to 100% accurate to judge the market that when it will actually crash. Nobody will know that, okay, period. So we only have 85% of the accuracy, the winning chance. So because we can't, even Warren Buffett cannot predict the futures. So what he said is that he understands that the market is very fluctuating the pricing itself. So what he do is actually he pick the right stock, choose the right timing. Like example, in the 2007, the Lehman Brothers incidents, right? Many people sell in panic. They just sell the stock and just run away. During that period of time, or even 1997, the financial crisis, do we realize that the share prices dropped mostly more than 50 to 60%? You can go to US, you can just surfing for the US stock and just try to filter or screenshot or screen it out. Or even you can go to Malaysia stock, Singapore, we can go to Indonesia, and most of country that you can mention that got stock market or security that is almost all drop and really decline drastically, plunge. But during that period of time, how many of us would dare to actually go in and grab this piece of stock at a cheap price? Which is like Warren Buffett always say, he discovered one of the best way, which is we have to be greedy when others are fearful and be fearful when others are greedy. This is a quote that actually by Warren Buffett. And Warren Buffett is always right, and he's actually already mentions the most important investment G's, which is the habit that we do need to have, which is at the timing itself. Because we have to choose the right timing. And when's the right timing? Is when the stock markets actually plunge and they sell it at a discounted price. And when will be the times that the stock will sell at a discounted price? All those good companies, they will not be given us discount, right? So when is the time that they will give us discount? That is when the Mr. Market is mispricing and making a huge and big mistake. That's in a crisis. So right now, people might asking, when is the crisis? So I have shared it actually into one of my video in the YouTube channel. In the Mandarin actually, I call it is the tortoise investment philosophy. And in the tortoise investment philosophy, I just make it a very short sharing, a summary. That tortoise, we understand they got characteristic, right? 4 characteristics. Number one, they're actually very slow. Those people might thinking that if I'm moving very slow and I'm doing value investing, really, is it really that I can make money? And a lot of people oftentimes that they make a mistake and they choose a fast track. They then put in their money into in the very certain of promising so-called return like 10 or 20%, and at the end of the day they just get into so-called a scheme of scam. And this is actually very sad thing that I see that's happening around the world. If we really want to invest, we have to rely to a real methodology we call value investing in stock market. And you don't want to be the value investor, then perhaps you just take your money and just buy property which is undervalued, then it will be safe. Okay, in my point of view. So let's come back for the tortoise investment methodology. So in tortoise itself, number one, the characteristic is very slow. So if we slow, then at least we actually will meet the first criteria from the rules from the Warren Buffett, which is never lose money. Why? Because if we slow, no matter the market how it move, sooner or later it will come back to the real value. Okay, why? Because the company is really worth such value. So in today, if we calculated that the company that's only worth, maybe perhaps it's worth $15, and it's sell at $7.50. Like I use the same example like just now, 50% discount. And we are very safe because no matter how the markets move, as long as we choose the right time, when the markets really plunge and everybody's very greedy and we get it at the time, and we are very safe because the market eventually the profit take care by themselves. We don't even need to take care. So what we need to take care is, we just need to take care when that's the bad time. We have to protect ourselves by the margin of safety, which is we must buy at a discounted price. This is number one. Slow is good, it's always good. Number two is to talk about tortoise characteristic. We know that tortoise is actually they choose the season to eat. When actually in the spring, then we start to have their appetite back, and in the winters, they will tend to be like a bit lazy and to hibernate themselves, and they don't have the kind of appetite because it's very cool. They don't like the kind of temperatures. So sometime after a period of hibernators, when they come back, right, they will see they really get hurt into their body and the skin. All this really is no good. Why? But why they are still hibernating themselves is because they understand not every time is a good time. Like we invest in stock market as well. Not every time that the stock markets they mispricing or the Mr. Market is making a mistake. Not every time. It's only occasionally they make a mistake. So only when we get into the time when they make a mistake, then we will be very safe and will make money. And of course, as a tortoise, we understand that another characteristic is they always have a shield to protect them. So it's the same, we have to protect ourselves. So how are we going to protect ourselves? It's through so-called the buffer of security, as I mentioned in my books, which is if today we calculated $15 as the real price, we minus $7.50, that is $7.50, right? There's a margin of safety. And doesn't mean that I will wait until $15 then I sell it. I use the $15 and I will take a 20% perhaps, or even more. 20% it will just take about roughly 10% is $1.50, 20% is probably about $3, that is $12. So in the $7.50 we bought it, and the $12 roughly we will sell it away already, which is we call it buffer of security. After the margin of safety, I extend it, which is the buffer security, which is more safer, much more safe to us. Okay, but this is the way that many people will not practice even they know it. The reason is because greedy, right? Because we see the price keep on going up, they say, okay, it can go to even further, like $15 to $17 or $18, and why not just keep the stock and wait at the uptimes, the optimum price, then sell it away. And that really happened, that apparently I can see. Essentially, most people who use that, they will lose money, trust me, because normally when the share prices are going to the up, really maximum point that it will plunge, it's a bubble. That is the same around the world, they never change. It's the same throughout the decades, right? So even Benjamin Graham, Warren Buffett, they experience the same way. The Pure Alto speeches, all you can mention with the value investor, they face the same so-called incidents. So just now we talk about number one is the buying the low prices, the habit. Number two, which is always have the protection and getting the right time. And what's the last one? The last one I would like to wrap up by saying is we always have to believe in ourselves. It's because Warren Buffett said as well, and all the value investors, very simple investors always mention, we have to get into the field or the sectors that we're really familiar about. Like take an example, we're familiar about the industrial sectors that are manufacturing for glove, okay, or even manufacturing for electronic items, semiconductor, or property sectors. Then we get after the sectors because we really understand about the sectors, and we study everything and we calculated the real value, and we have to stick to it. We have to stick to our plan. But the problem is people always tends to believe other people's opinion than themselves because they don't have enough confidence in themselves. They always think that other people is better than us. Other people might have a better analysis. Because for value investing, we may be very lonely, and because we already calculated the real value, we know it will go up in just about time. And sometimes when we tend to wait for a little bit longer time, like 1 year or 2 years, and suddenly, and somebody is just approaching us and just tell that, I tell you this market for this sector is bad, this stock is really no good. Why not you just sell it away? Because sudden news has come up and going to affect the stock. after even though we do our homeworks and we give up, we just sell it away. So eventually we don't have that luxury to actually enjoy that fruits, which is the return. And sometime that you can say in 2007 to 2016, you will be able to actually go through to access certain stock like GE in US, or even you can LMT and much more stock. During 2007 to 2016, they have grown up more than 500 to 600% for your information, ladies and gentlemen. So we might not have this kind of luxury to enjoy this kind of fruits. So if we want to enjoy this kind of fruit, we do need to really be patient. That's one of the key I would like to share with you guys, that to be patient. To be a stock investor, we have to be patient. Well, so Tony Lim here, and today this is my sharing. I hope my sharing will give some benefit to you and to bring a little bit of information about value investing and how to apply the right way to invest in stock market and to make you to be a profitable investor and traders. Thank you, and hope that we're going to see you again in my upcoming sharing section and also the upcoming event. Thank you.